Welcome to another video of financial indicators by Fahad M. Gohar. This is going to be video number 12. This video actually is related to the subject of very well known, which is the retail sale month over month. What it does, actually it measures the changes in consumer spending from one month to the next. It provides insight into the health of an economy, since consumer spending, of course, typically account for a large portion of the economic activity. Government usually use retail sale data to monitor economic condition and consumer behavior. Steady increase, of course, indicate a healthy economy, which allow the government to maintain or tighten fiscal and monetary policy. A decline in retail sale might also prompt stimulus measures such as, tax cut or increased public spending to boost the economy. Business usually monitor retail sale. Positive trend often lead to expansion in inventory growth and hiring, while negative trend can prompt cost-cutting measures. The calculation actually for the retail sale month over month is very simple, formula. Let's say, for example, you have a company, that has, production increase from 1,000 unit in January to 2,000 unit to 1,200 unit in February. It's very simple. You deduct the 1,200 minus, of course, the 1,000. You divided them by the 1,000, which is the initial month. You multiply that by 100, so you get 20%. That's the increase that happened. Decrease will be the opposite. Let's say a company dropped from 1,200 unit in March to 1,000 unit in April. You will do the same thing. You will bring the 1,000, you minus the 1,200 from it. Of course, you start always with the higher, the last one. You divide it by 1,200, which is the initial. You multiply by 100. You get minus 16.67%. So the calculation is very simple. No need to elaborate on it. So now let's go and see how we categorize it, from low to high, because this is very important for us to conceptualize, how this growth, works out, and how we can really visualize at what level we can see there is a growth or there is a decline. And here I will give you just snap idea so you can understand. Let's start first. If there is no growth, that means it's going to be between 0 or negative. Anything below, so there is non-growth, we call it. Okay, usually at 0 point or anything, so there is non-growth at that point. Now if it is between 1% to 5%, we call it small growth. If it is between 5% to 20%, we call it moderate growth. And if it is above 20%, of course, we call it high growth. And now the opposite. Now, if it is between -1 to -5%, we call it small decline on the, of course, the growth of the, the sale month over month. If it is between -5 to -20, we call it moderate decline. If it is bigger than -20, we call it high decline. So you can this way visualize, where you're standing, in your, economy, or that particular country you are looking for. At what level are they in growth or are they in decline? If you see minus, always they are in decline. If you see plus, they are in growth. But at what level? Small, moderate, or high growth. So now let's move on to the next slide. Let's see what, if we have a strong retail sale, what aspect will be affected, and then if we have a weak retail sale. So we're going to start with the strong retail sale. Let's go first with the market confidence. Of course, when we have a strong retail sale, what's going to happen? It can boost market confidence as it indicates healthy consumer spending. This confidence often, translates into a positive market sentiment, potentially, of course, driving up the stock prices. So the market confidence goes up. How about the interest rate? Central banks like the Federal Reserve monitor retail sales as part of the assessment of economic condition. Strong retail sales, might prompt an interest rate hike. Why? To prevent overheating and inflation. So interest rate goes up. How about the bonds? Of course, bond prices will fall. Where retail sales are strong, indicate potential economic growth and higher inflation, bond prices may of course decline, and yield will increase as investors anticipate possible interest hike, so the newer bond actually will have higher yield, but all the older bond will be less favorable and their price will fall. How about the currency value? Of course, a rise in retail sales strengthen a country currency due to expectation of a higher interest rate, so the currency value goes up. How about the government debt? What happened to it? A high retail sale can reduce the government needs to borrow because it has a lot of money available for it, as increased economic activity generate high taxes and revenue, so no need for the government to borrow money, so government debt goes down. How about the stock prices? Stock prices rise. Positive retail sale data typically boost stock prices, particularly for retail company, consumer goods, of course, manufacturers and related sectors. So the stock prices goes up. How about the corporate earning? Of course, stock price goes up means, also retail sales directly impact the corporate earning, especially in consumer-centric sectors. Strong sales lead what? To higher revenue, to a better corporate earning. So corporate earning goes up. How about inflation? A high retail sales can drive up demand for goods and services. Potentially, of course, that could lead to inflationary pressure. Central banks at that point may adjust monetary policy to control inflation, so inflation goes up. How about if we have now a weak retail sale? What will happen to those aspects that has been just discussed in the previous slide? Let's start with the market confidence. A weak, report can trigger concern about economic health, and which will lead to market volatility. So the market confidence eventually will go down. How about the interest rate? Weak sale could result in a rate cut to stimulate spending. So the interest rate will go eventually down. What about the currency value? Of course, declining retail sale can weaken the currency as the central bank may lower rate to stimulate the economy. So the currency value will go down. How about the government debt? Government debt, of course, low retail sale may force the government, to increase borrowing to fund stimulus measures and operation. So it will need to, borrow more money, so the government debt will go up. How about the corporate earning? Of course, weak, sales affect profit margin and business expansion plan, which means the corporate earning goes down. How about the bond? Of course, the bond price now here will go up. Weak retail sale can boost bond prices as investors, of course, will seek safer assets, which, be the bond, even though the yield might decrease, but they are safer now. So the bond prices will go up because people will be looking for bonds. How about inflation? Low consumer confidence can lead, of course, to reduced demand, which will potentially lead to deflation pressure. So the inflation will go down. How about the stock prices? Of course, the stock prices will fall. Poor sales can lead, of course, to sell off. particularly in consumer driven stocks. So the stock prices will go down. So this gives you an idea the effect of a strong retail sales and a weak retail sales on those aspects that are very important to our economy. So now here side by side for the same subject we just discussed in the previous two slides, just for you to be able to compare side by side. So now let me give you just this small chart, give you some idea. That's the retail sale, of course, month over month, percentage wise. We already discussed that in the slide. Now on the retail sale, of course, market confidence, interest rate, we just discussed those, but now we can see it here month to month. You can see, now you can see how it affects, and how it works, both together. Of course, this line here, the purple line, that's the stock prices. Stock prices goes up accordingly. So I hope this video was very helpful in making you understand the retail sale month to month and how it affects your economic decision. See you in the next video.